Don't sell before Sunday, the weekend silver gap. Setup, I need to pause you before you make a choice you'll regret for years. If you're thinking about exiting your silver position today to sidestep weekend exposure, I'm urging you to hold off until you've absorbed the data I'm about to lay out. The setup forming for Sunday's market open is unlike anything I've chronicled in my years of monitoring precious metals. Every single metric I track is converging toward a potential opening gap so dramatic that selling Friday afternoon could mean forfeiting 10 to 15% gains by Monday morning. I'm not citing these figures for shock value. I'm citing them because the documented data mathematically backs this outcome as a plausible scenario. The weekend configuration points to a massive move, and the evidence overwhelmingly suggests that move will be upward. Before I lay out the specific evidence supporting a potential substantial Sunday gap, let me be perfectly clear about my principles. I will never solicit your money. No paid signals, no programs, no mentorship offerings, no premium memberships, no investment partnerships, no paid communities. If anyone reaches out claiming to represent this channel and requests payment for anything, that's a scheme engineered to exploit the trust this community has cultivated. Report it immediately and protect yourself. I produce this content because weekend gap situations create lopsided opportunities deserving thorough analysis. This is financial education, not financial counsel. Confirm every assertion through primary sources. Base your decisions on your own circumstances. Now let me demonstrate precisely why today is the worst conceivable day to sell and why Sunday could deliver the move we've been anticipating. This morning's PCE inflation figures fundamentally altered the Federal Reserve's standing. The PCE price index registered 2.9%. Surpassing the 2.8% projection and climbing from the prior reading. This is the Fed's favored inflation measure, and it's trending in the wrong way. Inflation is quickening, not easing. The Fed is now cornered between impossible options. They cannot lower rates with inflation at 2.9%, and climbing, cutting rates while inflation accelerates would demolish their credibility and spark a dollar crisis. They cannot tighten further because the banking system can't absorb additional strain. Commercial real estate is defaulting. Regional banks are faltering. Federal government interest costs already surpass $1 trillion annually. This bind represents the most favorable possible backdrop for precious metals. When central banks lose their grip on inflation while being unable to tighten policy, hard assets like silver become the sole defense against currency erosion. This morning's PCE figures confirm the trap is sprung with no way out. Here's why this is especially relevant for the weekend. Major institutional traders require time to process this data and realign their portfolios. Friday's trading window is too compressed for complete repositioning. Many portfolio managers follow weekly rebalancing cycles that execute Monday morning. The institutional reaction to today's inflation numbers will surface in Sunday evening's opening and Monday's full session, not in Friday afternoon's abbreviated trading. Selling Friday means selling before institutional purchasers have fully responded to the inflation trap confirmation. You'd be handing exit liquidity to the same 633 institutional accounts that orchestrated overnight short attacks, enabling them to cover at depressed prices before genuine buying commences. The physical supply configuration makes this weekend especially volatile. COMEX registered silver inventory stands at 98.1 million ounces after plunging below the pivotal 100 million ounce boundary this week. First notice day for March contracts lands in precisely 7 days. March open interest represents 429 million ounces of paper claims against that 98.1 million ounces of deliverable metal. At the current outflow rate of 785,000 ounces daily, registered inventory will decline to roughly 92 million ounces by Monday's vault report and 85 million ounces by first notice day. The coverage ratio is approaching 5 paper claims for every single ounce of physical metal. This ratio has never been stress tested during a major delivery month. Here's the essential point about weekend timing. Physical silver continues trading throughout the weekend in markets that never shut down. Dealers in Hong Kong, Singapore, Dubai, Mumbai, and London execute transactions around the clock. Industrial procurement proceeds without interruption. Sovereign wealth fund purchases go through regardless of Western exchange timetables. Government stockpiling operations run continuously. During the 52 hours that Western paper markets stay closed, from Friday 1:30 p.m. Eastern through Sunday 6 p.m. Eastern. Physical silver trades at physical prices. The Shanghai Premium currently sits $52 above Western paper, with physical silver at $130, while COMEX paper trades at $78. Every physical transaction this weekend takes place at prices dramatically elevated above Friday's Western close. When Globex reopens Sunday evening, the initial trades must reconcile Western paper prices with the physical market reality that evolved during the shutdown. If physical silver exchanged hands at $130 throughout the weekend, while paper closed at $78, the arbitrage pressure compels immediate repricing. Sellers unwilling to part with metal at $78 withhold their offers. Buyers seeking exposure bid progressively higher until sellers materialize. The gap materializes instantaneously. Backwardation arises when spot prices exceed futures prices. This inversion develops only when immediate physical demand grows so acute that buyers pay premium prices for metal now, rather than awaiting scheduled future delivery. The Shanghai silver market entered pronounced backwardation this week. Industrial users don't break for weekends. Chinese solar manufacturers need silver Saturday and Sunday to maintain production schedules. Electronics factories run without pause. EV battery production operates non-stop. These industrial buyers will source silver through weekend dealer channels at whatever prices sellers require. Those prices incorporate backwardation premiums layered atop already elevated Shanghai physical prices. Weekend transactions at backwardation prices set the benchmark for where physical silver trades when Western markets resume. DecodeX opens into a landscape where backwardation premium transactions occurred uninterrupted for 52 hours. The paper market must recognize this physical reality in its opening price. The Lunar New Year holiday stretch has officially concluded. Chinese markets now function at full capacity with complete staffing and standard trading volumes. Chinese industrial purchasers, investment funds, trading operations, and state enterprises work throughout the weekend formulating acquisition strategies. Chinese silver imports topped 700 tons in January alone, representing 32% of annual global production flowing into a single country. This import velocity reflects industrial necessity and strategic stockpiling that won't pause for Western weekend schedules. Chinese buyers comprehend the supply predicament. They're paying $130 per ounce because that's what physical silver commands in markets where delivery actually happens. The removal of manipulative traders this week adds upward momentum. The Shanghai Futures Exchange identified and banned 6 clusters of coordinated accounts that had been artificially suppressing prices through concentrated short selling during the Lunar New Year break. With these manipulators expelled, the synthetic downward pressure they exerted has evaporated. Prices are anticipated to snap toward physical market valuations as manipulation recedes. This enforcement action occurred just before the weekend, meaning Sunday's opening will be the first complete Western session free from that manipulation pressure. The compressed spring has been released, and Sunday may expose how much higher prices would have been without the interference. The geopolitical landscape creates lopsided weekend risk that strongly supports maintaining positions. The Iran situation has escalated throughout the week. Military deployments, naval maneuvers, and combative rhetoric from both sides. Over 50 fighter jets stationed in the Middle East. Partial Strait of Hormuz closure for Iranian naval exercises. Vice President Vance declaring Iran refuses to honor administration red lines. Military operations have historically been launched over weekends when markets are dark. Government planners recognize that Friday evening action provides 48 hours of military development before market reaction. This elevates the probability of weekend escalation that would convert Sunday's opening into a safe haven buying frenzy. Here's the imbalance you must grasp. If nothing unfolds geopolitically, silver opens based on the other dynamics I've outlined, potentially 5 to 10% higher. If military strikes occur, silver opens 15 to 25% higher or more as a war premium gets priced in instantly. The downside from holding through the weekend is limited. The upside from potential escalation is boundless. This asymmetry decisively favors holding, not selling. The coordinated assault by 633 institutional accounts actually reinforces the argument. For maintaining positions through the weekend, these traders piled on roughly 8,400 short contracts during the pre-dawn low liquidity window, pushing prices down ahead of the PCE data release. They manufactured weakness through artificial selling pressure. Here's why their offensive misfired. By forcing prices to the bottom of the recent range, they wound a tighter spring. The shorts they established must eventually be unwound. The covering purchases add to upward pressure. They suppressed prices into bullish fundamental data, generating a contradiction that will resolve toward higher prices as traders absorb the inflation implications. The shorts added overnight are uncovered positions with no physical support. Registered inventory can't sustain delivery against current open interest, much less the fresh shorts piled on overnight. These positions will be closed through purchases at elevated prices or result in delivery failures that expose the paper market's dysfunction. Either result is constructive for silver prices. The commitment of traders, data publishing. Friday afternoon will unveil the complete positioning landscape. Early signals suggest commercials expanded shorts, while managed money maintains sizable long positions. This arrangement typically precedes price acceleration as commercial short covering intersects with momentum purchasing. If the KOT report confirms ongoing commercial short concentration against shrinking registered inventory and an approaching delivery deadline, institutional traders will position Sunday evening for the showdown between paper claims and physical reality. The informed money will buy Sunday's opening, not sell Friday's close. The $12 billion Strategic Critical Minerals Initiative, launched February 2nd, is actively procuring physical silver through direct agreements with miners and refiners. Government acquisition doesn't halt for weekends. Offtake contracts execute on their own timelines. The U.S.-Uzbekistan Critical Minerals Agreement, signed Thursday, confirms bilateral government-to-government procurement programs that circumvent public exchanges. These arrangements lock up supply before metal reaches commercial markets, further constraining available inventory for private purchasers. Government stockpiling intensifies the physical deficit. Here's the detailed probability breakdown for Sunday's opening. Scenario 1. Silver opens $10 to $15 higher at $88 to $93. This outcome requires geopolitical escalation, dramatic continuation of vault depletion revealed in Monday morning's report, or institutional realignment driven by Friday's PCE data. Probability 25%. Scenario 2. Silver opens $5 to $10 higher at $80 to $88. This outcome requires natural continuation of prevailing trends with physical premium dynamics, Chinese buying momentum, and institutional reaction to inflation figures. Probability 35%. Scenario 3. Silver opens $2 to $5 higher at $80 to $83. This outcome requires modest positive momentum without extraordinary catalysts, the minimum anticipated move given physical market dynamics. Probability 25%. Scenario 4. Silver opens flat to marginally higher at $78 to $80. This outcome requires zero weekend developments and complete persistence of the current disconnect. Probability 12%. Scenario 5. Silver opens lower below $78. This outcome requires meaningful de-escalation, surprise inventory inflows, or a broad risk-off episode impacting all commodities. Probability 3%. The probability spread shows an 85% chance of opening at $80 or above, with a 60% chance of opening north of $83. The expected value of holding through the weekend is decidedly positive. Selling Friday surrenders this favorable expected value. The 3% likelihood of a gap lower must be measured against the 60% likelihood of a gap $5 or greater to the upside. Risk-reward analysis overwhelmingly supports maintaining positions through the weekend rather than liquidating into Friday's close. Fear of a weekend gap lower. The probability assessment shows merely a 3% chance of significant downside gap. The catalysts that could trigger downside, major de-escalation or supply flood, are both highly improbable within a 52-hour span. De-escalation demands diplomatic breakthroughs requiring weeks to materialize. Supply increases require mining expansions taking years. Desire to secure recent profits. Silver at $78 represents a 70% discount to Shanghai Physical at $130. You're not securing gains at fair value. You're exiting at artificially depressed paper prices that physical markets have dismissed. The profits worth capturing arrive when paper aligns with physical. Those gains haven't materialized yet. Avoiding weekend unpredictability. Unpredictability works in both directions. Weekend developments are more probable to be bullish than bearish, given the specific circumstances at play. Dodging weekend uncertainty means dodging weekend opportunity. The imbalance favors engagement, not retreat. Taking chips off the table, this presumes investment returns only become real when converted to cash. But cash is itself a position carrying its own risks. Cash hemorrhages purchasing power to inflation that just registered 2.9%. Cash forfeits the gap higher that holding would capture. Moving into a depreciating currency to avoid holding a scarce commodity isn't self-evidently wise. Here's what I'm doing with my own holdings, shared purely for educational purposes, as this is not financial counsel. I'm maintaining my complete physical silver position through the weekend. I'm not parting with a single ounce on Friday. The data I've presented supports this choice. The probability analysis favors holding. The fundamental thesis stands. The delivery deadline closes in within 7 days. The $52 paper physical gap cannot endure indefinitely. My position sizing permits me to withstand volatility without strain. I didn't commit capital I can't afford to lose. I didn't employ leverage that invites margin call danger. I hold physical metal that can't be forcibly liquidated by counterparties. My situation supports holding. Yours may be different. 7 days until first notice day. 98.1 million registered ounces against 429 million paper claims. PCE inflation at 2.9% confirming the Fed's bind. Shanghai premium at $52 demonstrating physical silver is valued at $130. Backwardation in Shanghai validating urgent immediate demand. 633 institutional accounts stacking naked shorts that must eventually be unwound. Geopolitical tinderbox with heightened weekend escalation risk. Every data point supports holding through the weekend. Those selling Friday are furnishing exit liquidity to institutional manipulators at artificially suppressed prices. They're abandoning positive expected value gap capture. They're selling at a 70% discount to physical market pricing. Don't sell today without comprehending what you may be sacrificing. The weekend configuration suggests a substantial move. The probability distribution overwhelmingly indicates that move will be upward. Sunday evening could mark the beginning of paper prices converging toward physical reality. Confirm the data. Evaluate your own situation. Make choices grounded in documented probabilities rather than baseless anxiety. This is financial education. The weekend commences at 1:30 p.m. Eastern Friday. Sunday's opening could alter everything. Position yourself accordingly.